Good afternoon and welcome to the i3 Emerging Market Debt webinar co-hosted with Capital Group. I'm Tech 10 with i3 and I'm pleased to have me, Freitas de Oliveira, join us today. Welcome, Luis. Now, Luis is a partner and a portfolio manager at Capital Group, focused on emerging market debt as well as multi-asset emerging market strategies. He has 33 years, or in fact, more than 3 decades of investment experience, and has been with Capital for the last 28 years. Now, given Luis's multi-asset background, I will draw this into a broader EM discussion in the latter part of the webinar, once we've covered the EMD aspects sufficiently. So looking at this year, it's been an unrelenting year of negative headlines with the war in Ukraine, inflation concerns, recession fears. This year has also been particularly challenging for emerging market debt, or EMD, as the asset class has experienced drawdowns even larger than what we saw during the 2008 global financial crisis. And some of the numbers I've been seeing year to date, the hard currency USD sovereign debt index is down some 18%. Local currency sovereigns are down 14%. Hard currency corporate bonds down about 13%. So not looking pretty at all. And a confluence of factors, some we're familiar, has led to this weak performance. The aggressive Fed hikes, high inflation rates, the strength of the dollar, geopolitical tensions, defaults, recession fears. Now, hopefully I haven't frightened away any of our institutional investors currently listening in before we even get started. But look, before I ask Luis to soothe some of our nerves here and perhaps convince us on how this asset class remains investable amid the growing headwinds, just some admin points on this session. So this will be a 40 minutes fireside chat between myself and Luis rather than a formal presentation. Now, where appropriate, Luis may have a couple of technical charts just to illustrate some of the points. I encourage you, the audience, to submit questions via the question box anytime, and we'll endeavor to answer them in the course of the conversation. This webinar is for educational purposes only. It does not constitute financial advice. It is intended for wholesale and institutional investors only. So, Luis, let's get started. I think first and foremost with the macro, and we are all familiar with the very challenging macro environment. Perhaps you can first and foremost take a step back and look at the big picture, and if you could give us, at a high level, the evolution of emerging market debt as an asset class, and how investors should be thinking about EMD today. Luis?
Yeah. Thank you very much. Pleasure to be here and to talk about emerging markets. It's really a fascinating field and one that I've dedicated my entire professional life to. And I think you pointed us to the right direction. It's very important to get perspective and what exactly is emerging markets today. Many of our perceptions of the asset class come from history. Emerging markets investing by developed market investors really started in the late 80s, early 90s, when the asset class was basically dollar only, or hard currency only, and basically defaulted debt, restructured. We're mostly talking about Latin American debt and then the Eastern Bloc debt that was defaulted and restructured. So we're by definition talking about extremely high yields, high level of legal uncertainty and distress. That was the nature of the beast. The returns turned out to be extraordinary. So was the volatility. There's a very high correlation to equities. This was definitely a return-seeking asset class, uncorrelated to treasuries. You really, most of the time, we're trading dollar prices, not spreads. Fast forward, that restructuring process worked with the fall of the Berlin Wall, with the reforms inspired by what I think people agreed to call the Washington Consensus, led to a period of fast growth and stabilization of finances. Notwithstanding the Asian crisis, the Russian crisis, the Brazilian crisis, the trajectory was one of a growing asset class where a very large part of the universe moved from distressed restructured debt to actually investment grade. In parallel to that, most of those markets developed deep local markets, which gave them alternative source of funding, reduced their dependability on foreign capital, and gave investors like ourselves many more levers to make money there. We can now invest in currencies, we can now invest in curves. Also, in parallel to that, there has been a tremendous growth, probably the fastest growing part of the universe, in the emerging markets corporate bond market. So now when we talk about emerging markets, we're talking about actually a very diverse set of securities, ranging from extremely high quality bonds. Let's take one example, like Qatar, which has sovereign credit metrics better than any OECD country, and it's a AA country. And all the way to Sri Lanka, which is trading on 20 cents on the dollar. It's technically in default, and everything in between.
Sure. I think that's really interesting, and certainly I'd like to do a deeper dive into the various bits of what are subsets of emerging market debt. But if I could stay at sort of the high level for a bit more, and the macro piece, we've seen obviously inflation in the US and the tightening cycles in the US. And again, when we think of US tightening, it's always been a source of stress for emerging market economies in the past. I'm wondering if it's the same now, given what's happening.
Yeah, at the very macro level, the tightening of US policy has been the headwind for all asset classes this year. And emerging markets not different. Maybe you can show this slide that shows the returns of the emerging markets that in this period relative to others. You mentioned some of the numbers, Dick. So emerging markets have suffered. There is no doubt about it. And it's very hard to believe that we are going to see strong positive returns until we have some stabilization or we get closer to the end of the tightening process. But that's true not only for emerging markets, that's true for most risky assets and assets that are tied to the price of US rates. So let's be clear, there is no light at the end of the tunnel for pretty much any asset class until we are somehow stabilizing on the US rates front. Specifically on the vulnerability of emerging markets to the US rates, I think we are at a low point of vulnerability. And the reason being because the emerging markets have diversified the source of funding. They are significantly less dependent on short-term dollar debt. They have a longer liability profile. They have sources in local currencies, and they have significantly more foreign reserves. So while it is a headwind like for everything else, it is, in relative terms, one of the moments in the history of emerging markets where emerging markets are the best prepared to deal with a tightening in dollar liquidity conditions.
Right. I can see on your charts you've compared obviously currently 1 year trailing and the global financial crisis about 20 years ago and COVID. Some would also try to compare the not so long ago in 2013 there was the taper tantrum. How do you compare then and now?
Yeah, taper tantrum was a much shorter episode, very traumatic for emerging markets, in particular to currencies. And the big difference, and I unfortunately don't have a chart to support that, is that before taper tantrum, emerging markets currencies had been very strong and were screening very expensive, and we had a lower level of reserves. So taper tantrum really wrong-footed a lot of emerging markets countries at that point in time. It was quite painful from a pricing perspective. Interesting, that did not lead to many defaults or distress, but from a market price perspective, is a pretty unpleasant event. The good news, if we want, is that taper tantrum tested some of the hypotheses I just put forward here, that there were more diversified source of funding. And the fact that the currencies devalued allowed for local currency funding to become more attractive at this point in time, for investors came at one point in time. This was the emerging markets, mostly a floating rate market at this point in time. So we adjusted. It's painful for investors that were there before, but clearly it allowed those countries not to default, which is at the end of the day, fixed income investors probably one of the most, that's the beginning of a bullish story in any asset classes. Can the company or can the country react to a shock without leading to a default? In this sense, taper tantrum was a good episode. Terrifying when you're watching the prices come down, but from a fundamental perspective, most countries got out of the other side of this strong.
I guess this goes to, again, in your opening remarks, when you talk about, I guess, the history of emerging markets, where I know in developed world here, we talk about inflation and we struggle with inflation, but emerging markets have been dealing with high inflation, even hyperinflation, pretty much all the time. But I guess what I'm hearing from you is that over the years, through the different crises and different incidents, that they seem to have more experience in dealing with that, but have sort of responded to that, because one of the observations that, while it's interesting to see that we're actually seeing parts of developed markets now obviously having higher inflationary pressures than EM countries. They seem to have been coping well in the past, or what's the story there, given, I guess it's really lessons from the crisis they've been through to start building up local capabilities. Can you elaborate a bit more on that?
Sure. I have a relatively simple narrative. I mean, developed markets ranging from Australia to the US and Europe have accumulated a high level of central bank credibility. And they used up this credibility with very unorthodox policies of negative interest rates, so zero negative real rates, quantitative easing, and even start believing things like transitory inflation, the MMT. So all those theories, in my perception, is that we are using up, the world was using up the credibility built by OECD central banks over a long period of time. Emerging markets never had that credibility. They could never engage on long periods of negative rates. They could not pursue massive quantitative easing programs because they just were still, the memories of very high inflation, the memories of instability were still too early on. And so they never did it. And accordingly, with a couple of exceptions, primarily in Eastern Europe, which is monetarily very tight and linked to the euro and what's going on in the ECB, emerging markets very quickly reestablished real rates as soon as inflationary pressure started. And of course, I mean, if you believe like I do that inflation is largely a monetary phenomenon, that positions many of the emerging markets, most of the emerging markets, quite well relative to developed markets in terms of controlling the inflation situation. And we are actually seeing a few large emerging markets printing CPIs that are quite stable at the core level. And they are already at historically high real rates. So one can credibly believe that we may be turning, at least in a few large emerging markets, the tightening cycle. We can be getting out of it.
Right. So I guess in a sense, while we in the developed world have been arguing about, I think until recently we argued about whether it's transitory versus structural, what I'm hearing is that they have already been ahead of the curve. They have been aggressively hiking rates because of the fear of inflation. I guess they don't think whether it's transitory or structural. They just think inflation, it's a problem, let's do something. And hence, this, in a sense, ahead of developed markets in that cycle.
Absolutely, yeah. As usual, just one caveat. I'm generalizing. I mean, it's a large universe, as I said at the beginning. Most of the narrative I'll be developing here is centered around the large kind of core emerging markets. Most of us associate with the asset class, the Brazils, Mexicos of this world, the South Africas, Indonesia. We talk about them. I mean, when I want to talk about more idiosyncratic stories, I will mention it.
Yeah, I think it's useful because, again, I've loosely used the word emerging markets. And in fact, just laboring on that point a bit more, often when we think emerging markets, we think in very geographical terms. However, one definition that some would propose is perhaps to think of them or to classify them as, commodity producers or exporters versus importers. And with that, you have a better sense of how, I guess, they could tackle inflation and the implications of policy. Is that one way to think about it?
Yeah, I'm not a big fan. I think it's an important distinction. When you are analyzing a shock, like we had a shock right after the Russian invasion of Ukraine, you want to understand who is on the winning, who is the losing side. The problem with that categorization is that it's really only important for countries that are in the extremes, that are either very vulnerable or greatest beneficiaries. If it's a marginal impact, other variables are much more important. So it can put our attention on the wrong variables. Sure. So that is what, I'll give an example of my own home country, Brazil. Brazil is a beneficiary of commodities in general, but that's not the story there. The story there is really inflation and monetary policy. Because Brazil already had one of the largest foreign reserves. It has extremely low external debt denominated in dollars. So again, you're going to get a little bit more dollars. The balance of payment will get better, but that is not what you needed to look at to get comfort with Brazil. It's more about fiscal policy and inflation. Conversely, of course, a country like Sri Lanka, an oil shock like we had, is all they needed to definitely push them in a deeply distressed situation. So that's very important for them.
And so, again, touching on what we've just discussed, that differential, I mean, emerging markets, again, broadly have been hiking rates ahead of developed markets, and obviously there's that rate differential. Where you see that, is that going to continue to widen? Where do you see that playing out again? And then drawing that, what does it mean for fixed income portfolios?
I like to think about emerging markets in two blocks. The early risers, which are mostly Latin America, that started to hike rates very early for the reasons we just discussed, credibility. The ones that started following the US, kind of in the middle, that's most of them. Like they'll put South Africa there, for example, the big one, just an example. And then the ones that are dragging their feet. And some Asian countries would be on that last category because they are facing less headline pressure for a variety of reasons, including a lot of price controls. They are kind of trying to, wait and see if they can avoid a significantly tightening in the process. They also have economic structures that have dealt with negative real rates for a long period of time. You have to remember that during the Asian boom, a lot of the local rates were negative on an ex-post basis. It's one of the reasons that explained the very high level of fixed capital formation in Southeast Asia or in Korea, was that structurally the economy always had very low real or even negative real rates. So maybe the equilibrium real rate necessary for inflation in Asia will be lower. But anyway, the fact is that they are late in the process. So this is how I would think about it now. In terms of investment implications, obviously, I think the biggest opportunities are in the ones that hike rates very early, because you now have a very high carry and you have an opportunity of making capital gains as inflation comes down. You're being paid very high real rates in many of those countries now. I'm talking local currency. On the hard currency, it's a different story. And we can talk about it.
Yeah, I think this is a good segue, because I think we've sort of set the scene now, and I'd like to sort of do a deep dive really into the various sub-asset classes within emerging market debt. Obviously, you've got your sovereigns, both hard and local currency. You've got corporates, and then we could cover probably EMFX towards the end. But let's start. I think drawing on what you've mentioned, how broadly speaking, most emerging markets have definitely learned from their historical episodes of crisis and inflation, and are better prepared, more proactive this time around. So let's start by looking at hard currency sovereigns. Where do you see value in this space?
Before we go there, maybe you can share for a minute the slide that shows the characteristic of the two universes, basically using the indices for that. What I would like to draw the attention of our audience to is that how different the two universes are. So to the left here, we have the local currency index, the GBI-EM, globally diversified, and to the right we have the most used hard currency index, the NB, globally diversified. When you look at the local currency one, you have clearly a domination of the traditional large countries in emerging markets: the Brazil, Thailand, Mexico, South Africa, Indonesia, Malaysia. Those are the countries we always associated with emerging markets, China. And if you look at the green box that shows the credit rating, we are talking about a universe that is dominated by single A, triple B clients, a little bit of double B. There's not a lot of distressed situation in local currency. This is a rates effects market. We are not really talking about countries that would introduce capital controls. You're going to lose principal, you're going to restrict that. Rates effects. You move to the hard currency universe. It's a completely different universe right now. You can see on the green box again that you're really talking about half of the index being firmly below investment grade, and even a quarter of the index being in situations where default is a distinct possibility. They are either triple C or single B. And so credit risk is very important, default is very important, loss in event of default are very important considerations. This is the area where we should associate more closely with fragility in balance of payments, impact of dollar liquidity. That is the nature of the hard currency universe right here. And when you look at this rating breakdown here, it's very important to recognize that although there's a quarter of the universe that is in a situation that default is a possibility, you also have a double A and single A part of the market that is also not far from a quarter of the universe. So it's a perfectly normal distribution. And some of the credits here have better credit metrics than you would find in developed markets. So very complex asset class in dollars. So answer your question, or maybe you should look at the other slide, which compares the hard currency or the different subsets to other parts of fixed income market. The bar chart. Yeah, there we go. So going back to what I just mentioned, let's understand the legends here. In EMHC is emerging markets hard currency, emerging market local currency, and emerging markets corporates. So this is, you can see that now we are at levels of yield here that you normally associate with significantly outsized returns going forward. But that's not the point I wanted to drive home now. I wanted to break down the hard currency universe, so the first bar here to the left, and compare it to break it in investment grade and high yield. So going back to the ratings that I was talking on the previous page, what you can see here is that the emerging markets investment grade actually trades at very similar level to emerging market, to the US investment grade market, and very close to emerging markets corporate investment grade, which what it is suggesting to me is that there's not a lot of value in investing in emerging markets investment grade. It's always an idiosyncratic country-specific story, but as a sub-asset class, you are not being paid a lot to be in emerging markets investment grade. Conversely, when you compare to the right, emerging markets high yield to the US high yield market, there is a significant premium in emerging markets high yield. So here we talk about the more fragile part of capital markets, the parts that we should worry about the impact of interest rates and liquidities. But I would argue that quite a bit of it is already in the price. I mean, a lot of the kind of experienced investors in US high yield always say, once you get to 10%, close your eyes and buy. In emerging markets high yield, you're well above that already. And many credits in emerging markets high yield are already trading at levels that are associated with default and restructuring.
Right,
so that's
right. So I guess with local currency, look, it is cheap and it's maybe going to get cheaper. I guess to your point, this is the time for local currency to shine.
Local currency is a different story. Local currency, the cheap currencies, and as I mentioned, they tackle inflation earlier. Different dynamics. And I think to make a significant amount of money there, you need the dollar cycle to turn. That's a truism. And on the dollar side, you really, where you're going to make money now is on the high yield part of the universe, not an investment grade.
The high yield. Sure. And how do you compare, I guess, staying on sovereigns, you got your hard currency, which you have elaborated, and then there's a local currency bit.
Yeah. The local currency, always, by definition, is your returns will depend on FX. And you being Australians, that's an important consideration. For emerging markets investor itself is local currency. For you, it's a foreign currency. And you have, of course, rates and curves. I think I've already elaborated on why there's an opportunity in rates and curves in emerging markets, because they raised interest rates much earlier, and we are seeing CPI stabilization in many countries. On the FX, normally we think about emerging markets as some sort of a high beta bet against the dollar. And that history would say that is probably true. However, this time around, emerging markets currencies were weak much before the other currencies. So during the years where the euro actually was doing well, the emerging markets currencies devalued. So emerging markets are starting this process right now on a very cheap basis, based on traditional models measuring EM effects. So that's why actually emerging markets currencies have done better than the euro, better than the yen this year. So the playbook that emerging markets should suffer more when the dollar is going up didn't work this time. Of course, you lost money because it's the dollar strength. It has not been the case with emerging market weakness. It's been dollar strength. And emerging markets currencies have actually been proving more resilient than the euro and the yen. So the case for me here is that it seems, again, like with inflation, that currencies is stabilizing, and emerging markets currencies may be a very good place to be when the dollar cycle turns, which I don't have a clear view on time, but I think we are closer to that end than one would imagine. And our rates are already talked about.
Sure. I guess here again, because for the benefit of our Australian investors, there's a difference between a US dollar, an American investor versus Australian, because our currency here is pro-cyclical, and that does help out in terms of local currency as well.
Yep, absolutely.
And how about corporates? So emerging market corporates, this seems to be the fastest growing segment within the EMD market. Again, can you talk a bit about where you see value in corporates?
Yeah, emerging markets corporates have done very well. Part of it is mechanical. It's a shorter duration asset class than sovereigns by almost 3 years. So given what happened to treasuries, it's normal that they did better. It's a very skewed regionally asset class. The bigger part of the universe is in Asia, and with a very distinct investment grade segment and a very high yield segment. The high yield segment is dominated by Chinese real estate, so it's been suffering a lot. And the investment grade side is a great beneficiary of the liquidity, primarily in Asia itself. Private banks and institutions buy investment grade credit in emerging markets the same way they would buy corporate bonds elsewhere. It really made into the mainstream. Investment grade dollar debt, corporate dollar debt, is priced and placed with the same investors that would be buying investment grade bonds from developed countries. The high yield is a different animal and quite often very volatile. Sometimes it lacks a home, and that's why it presents a very volatile profile. We are cautious on the high yield part of the emerging markets corporates. I think that's one of the areas where there's been excesses in the past, and we would tread very carefully, especially in real estate in China. I think we all know the issues around that. Latin America is very different. It's dominated by quasi-sovereigns, so you are almost having a derivative of the sovereign analysis, like Pemex or Petrobras, that really just depends more on the country and the policy than it depends on the fundamentals of the issuer itself, plus a lot of commodity issuers. So very cyclical. Right now, they are in very good shape because we have had a few years of very good commodity prices, so balance sheets are well in good shape. We like them, but that's the big two areas here, and they behave very differently. We like corporates as a complement to sovereigns. They are very diversifying. They have a very different composition than the hard currency universe that I described to you. And we use corporates alongside sovereigns to get a better risk-return profile for the portfolio.
Right. It's also bringing it together, like you've covered different aspects, of this sub-asset classes within emerging market debt. Like you mentioned, hard currency, high yield seems more interesting than IGs. Local currency, interesting, but let's wait for the dollar to turn because there's still the headwind there. And then corporates, probably duration shorter, interesting there. Bringing it all together, how do you approach, again, for the benefit of the investors here where they're building multi-managed portfolios, how should they approach, getting exposure within this broader emerging market debt asset class?
I think if you're looking for one line in your portfolio, I think the traditional blended emerging market equity portfolios that have benchmarks 50-50, 50 hard currency, 50 local currency, is a very good way because we can use the relative attractors. We can play the relative value between the two asset classes that they are different over the cycle. There is a diversification benefit between the two, and you don't have yourself to worry so much about this kind of micro allocation over there. I would encourage investors to give some flexibility for the managers to use corporates in those portfolios without having to make a dedicated allocation, say something up to 20% of the portfolio in corporate, and really encourage the managers to take advantage of this large and diverse universe that I described in the beginning. This is no longer just a on or off asset class. There is enough diversity. You can move high quality, lower quality, more FX risk, less FX risk. It's a really diverse asset class. If you have capability internally and you want to decide which part of this universe is most attractive, my personal preference, and I think which is reflected in many of our portfolios, is for local currency. I think there is an opportunity now for early positioning in an asset class that will deliver outsized returns going forward.
Yeah, it's interesting you say that because in the past couple of years, I've seen some investors, again, this is more anecdotal observation, where there's a lot of concern around EMFX and the volatility uncertainty, we have seen certain investors choose to have dollar exposures minus the local currency bit. But what you're saying is the opposite, is that that's where the opportunity is currently, given the background that you've given us.
Yeah, it's we all have to asset allocate, and we all have risk budgets. We may call it differently.
Sure.
So I think it's all about what you have in your portfolio. Some people have relatively low risk allocations to fixed income. So it's very difficult to put something as volatile as emerging markets local currency there. Other people have a more flexible grid of allocation, and they can think of local currency as an alternative. It's a risk-seeking asset class, the same way as equities. And you can say, wow, the risk return emerging market local currency is much more attractive than emerging market equities at this point in time. So maybe that's how I'm going to invest in emerging markets. But it depends on the institutional setup of each client.
Sure. I think to your earlier point, again, it depends on really how the investor thinks about, is this a structural opportunity? And that might relate more to the dollar denominated type, or it's an alpha opportunistic type, which in this case, perhaps local currency could afford those sort of opportunities, depending on how the portfolio is being constructed. I'd like to move on to, I guess, when you talk EM, you can't not talk about geopolitical risk. But I might just pause here and perhaps encourage any of our audience, if you have questions, put it into the question box, and then we'll try to answer them as we go on. Luis, obviously, we can't talk EM without talking China. Obviously, it's more than just China. But let's try to put a finger on it. Now, I don't want to get into a discussion about the macro events and speculate what's going to happen, because it's not productive. But rather, I think we want to get into an investment discussion as to investment implications. So perhaps a first question for you, geopolitical risk, everybody talks about it. It dominates the media headlines. How do you factor geopolitical risk in your investment process? How do you do that?
Well, geopolitical risk is typically a tail risk, so very hard to price in. I think moments like today, where you actually have two major tail risks very present on the headlines and very present in the commentators' mind. What it does, that very crudely, it increases risk premium everywhere. And I think it's a moment where you want to be paid more to take risks, because you're just aware that things could go very wrong if a major geopolitical event happens. That could be, China taking an even more aggressive stance on Taiwan. That could be Russia escalating the war in a way that engages NATO directly. Just to take two clear examples. I think the low-level geopolitical risk is always with us, and the market tends to not price it at all. So to be a good investor in emerging markets, the good reflex historically is to ignore geopolitics. You have to be aware of it, but not take too much into account. Every time, it's not been a good deal to be overly worried about it. Of course, the common sense applies. If you're talking a lot about a geopolitical event and there is nothing priced in the securities that would be most affected, any good investor would step away. But to the extent we are not seeing aberrations like this, you just move on. Right now it's different, but I would say it's a case of general risk premium as opposed to very narrowly knowing how this is going to impact one country or another country.
Let's maybe get a bit specific now. If I could put you on the spot as well. Now, I understand that you have invested in Russia. In fact, you had an overweight position in Russia. That must be quite painful, reflecting on, was it late February when the conflict started unfolding?
Tell
us what happened. Why?
Yeah, for us, this was a classic case of getting something right and something wrong at the same time. And fortunately, I knock on wood, as I stand today, all our emerging market strategies are above the index again. So we managed in 6 months to recover, which points out to what we got right. When you take a position on an event like the Russian invasion of Ukraine, you need to make sure you size it in a way that if you're wrong, you can fight another day. So we were wrong. We thought that we were paid enough to take the risk in Russia, especially in local currency, that there could be a low-level conflict. We were absolutely wrong. We saw a huge invasion. We saw a tremendous reaction in terms of sanctions. So we got it all wrong. But we sized it appropriately. So we had a more or less 200 basis points impact immediately. We wrote it down, and then we made it up over the 6 months with other positions. And also, it's good to remember that local debts in Russia remain tradable. We were able to sell our Russian local currency debt between 25 cents and 40 cents. So the loss there wasn't as big as it would have been if you panic in March or April. And a bit of patience, a bit of perspective, and appropriate sizing is the way to deal with those shocks. And as I said, being one of the pioneers investing in emerging markets as a firm, we've seen it happen before. I mean, when Malaysia put capital controls in the global financial crisis, when we had the incredibly messy situations in Brazil a few times, you just have this playbook. Don't panic. Evaluate your alternatives. Don't manage your portfolio reading the Financial Times. And that is, normally you get out of it all right.
Right. It's about the sizing. In fact, my follow-up question, which is probably not more a question, is how might a Russian debt default? But from what you're saying, you don't expect to see a default. As such, it's not going to impact the global economy.
No, we didn't have any. The Russian economy has the ability to pay and the willingness to pay at this point. The only reason we had to write down things the way we did was because of sanctions.
Sure. And even to draw that again, we talk about lessons, from that incident into China. I guess that's the elephant in the room. What lessons do you draw from that whole Russian-Ukraine incident, and how has that then shaped your view of what is China? How do you approach China? How do you evaluate China?
Well, I think I don't do a lot of parallels between China and Russia. I think there is a significantly more erratic element on the Russian initiatives. And I think China is the direction of policy in China is significantly more consistent and signaled quite clearly that the debate is about speed and intensity, not about where the direction of China policy is going. So I think it's quite different. We approach China like any other market. We try to understand what is in the price, what it isn't. So clearly there was already a lot in the price in terms of more state control, more state intervention, less focus on growth, more focus on redistribution. That was already known. But of course, after the party congress, it seems that the agenda is going to be pursued more forcefully and quicker. So the market will price for that. But we're right on some things, wrong on others. So it is more investable still than on something that like happened in Russia. Honestly, I wouldn't draw parallels.
Yeah, I guess to your point, in fact, the observation is while often when we say geopolitics, we think China, but what I'm hearing from investors is that they seem to worry more about the local economy, the points you mentioned, the debt, the property, real estate market, even demographics, if you like, and the whole move away from some market-driven, or some would call that the whole concept of common prosperity, the speed as to how the local economy is operating. And on that,
one thing, talk about commentaries, just one quick brief. There is a big difference. China is a growing power. Russia is a shrinking power. So the psychology, the degrees of freedom, the objectives tend to be different. And there is something more constructive on a growing power than on a shrinking power.
Yeah, and just get a final comment on China. So with what's happening as you see in local economy in China, what does that mean for China bonds?
Well, China hard currency bonds are very high quality, very expensive sovereign ones, because the state has some of the largest foreign reserves. It has deep taxing capability. So it's not a very attractive opportunity. It's just a very high quality, very expensive bond. The local currency, it has done very well. It's one of the very few bond markets that really resisted the sell-off in the US bond market. And that is because the China economy was slowing while the rest of the market was booming. So bond markets did what bond markets normally do. They like slow economy. The challenge now is that you get a negative carry. You are not, you actually earn less in Chinese bonds than you earn on US Treasuries. And so for a foreign investor like Australians or most of our clients in Europe and the US, the question is, okay, I'm buying this for diversification, maybe a little bit of capital gains, but I don't get carry. And I'm still very exposed to, we're talking geopolitical events and all this. So it is a more challenging investment proposition today than it has been at any point in time over the last 4 or 5 years.
Yeah, I guess it reminds me again, your comment about Russia, I know it's different, where the credit ratings and so on for Russian bonds are fine. It's just that because of the sanctions, they can't. China numbers looks really good, as what you've just pointed out, but with the overhanging geopolitical risk, which is sometimes again hard to pin down, that creates concern again from the investors. Luis, in the last couple of minutes or so, I wanted to draw in, as I mentioned earlier, your background, because you're not just portfolio manager in EMD, but you look after sort of the emerging markets of multi-asset, and sort of get your comments, as you compare relative value across, there's emerging market debts, and we've gone through the different subclasses, and then there's emerging market equities. How do you compare that when you build your multi-asset portfolio?
Yeah, the first comment is that it's amazing how complementary those two asset classes are. The equities, in equities, China is the dominant factor. It's the largest country in the index. It has been the one that has offered a big diversity of sectors to invest in. It's deeply liquid. So China is the dominant factor there, while we just went through emerging markets debt and how diverse this is. And China is just a lot of country, in some instances, not even very important. That's the first point. The second point is that I think emerging markets equities remain more cyclical than emerging markets debt, so bigger exposure of state-owned enterprises, big oil companies, and utilities. So it has more of a flavor of old economy to it than traditional equities. So it's a very cyclical asset class. So we should be quite careful. I would be very careful if we do have a recession or a slowdown to be very aggressive on emerging market equities. You have on one side China slowing, on the other side a lot of cyclically sensitive stocks in emerging market equities. So it seems that at this point in time, emerging markets debt is more attractive than emerging markets equity for the reasons I outlined.
Right. Okay, that's interesting to see that sort of the value discrepancy and the comparison there. That's pretty much about time we have. Luis, maybe some final remarks on rounding up. I know we've touched on lots of, if you like, negative events out there. And the sense is that, yes, it is not great. Lots of numbers are not looking pretty. But what I'm gathering from you is that, yes, US rates, if the cycle turns, there are certain opportunities there. Maybe you could summarize in a couple of minutes for us.
Yeah. I think this is an asset class that is suffering like all the others of tightening financial conditions, but it offers fairly unique valuation and fundamental opportunities to be a place of choice, to be positioned for the end of the tightening cycle and the turn of the dollar. I think this is an area that could outperform other risky assets on the next stage of the capital market cycle here. And for the reasons we discussed before, I really consider it a place to add risk. Anybody who feels that this is a point to start adding risk again, to deploy cash or other safe assets into risky ones, that should definitely be part of the consideration.
Good. Thank you very much. And on that note, thank you very much, Luis, for sharing your research. And that's all we have. I hope for our audience this has been meaningful. We had recently interviewed Luis in an editorial article, and that's available online. And again, this is recorded for those who need to listen to it. So thank you, and we hope this has been useful. Bye for now.
Thank you very much.